everybody, it's Dividends of Tortoise Investing. Today we're going to be taking a look at 5 dividend stocks that you can buy and hold forever. There are 2 of these that I think are great growth ones. I've got 2 that are pretty good yielders, and 2 of them I consider dart throws that very well may pay off. None of this is financial advice, entertainment and educational purposes only. Always look into things before you buy them, but without further ado, let's go ahead and dive into things. Today we're going to be taking a look at United Healthcare Group, Dollar General, love them, Altria, Truist Financial Corporation, and HP Inc. Now let's start things off with United Healthcare Group. Absolutely love this company. This is probably my favorite healthcare company out of the whole bunch. It's got an adjusted free cash flow yield of 7.43%. It's got a dividend yield of 1.46% and a payout ratio of 30%. Take a look at the dividend yield. The revenue over the last 10 years been growing at a rate of 11.35%. That free cash flow has also been increasing at a rate of 14.42%. EPS right behind it, 14.75%. And that dividend over the last 10 years has increased at a rate of 20.98%. This is what it is to be a compound dividend stock. I love it. Their shares outstanding, they don't really buy back too many shares. They do here and there. And the return on capital employed is very reliably around the 18% zone. So yeah, United Healthcare Group, I really like what I see with this company. They've got $54 billion in debt. Their EBITDA is $29.8 billion. I don't like my debt to be 3 times more than what my EBITDA is. And this is definitely, there is no issues here whatsoever when it comes to their debt. Now, United Healthcare Group did just increase their dividend by 14%. And if you take a look here, earnings per share is forecasted to rise by 43.1% over the next year, and that would put their payout ratio to be around 25%. And here, since 2013, the dividend has gone from 85 cents to $6.60, which is a CAGR of approximately 23%. That is amazing. Next up, Dollar General. I love Dollar General. I've got 3 of these things within 3 minutes of my house, and I go to them pretty much every day. Now they're having a little bit of a free cash flow issue right now, but as you can see here from their past, things have been going in the right direction. They've have some issues this year, but I am more than confident that they are going to get things back on track. Take a look at that revenue. Revenue's been increasing at a rate of 8.98% over the last 10 years. EPS been increasing at a rate of 14.1% over the last 10 years. Dividend been increasing at a rate of 15.26% over the last 5 years. They do have a little bit of debt. Debt is at $5.72 billion. Their EBITDA is at $4.05 billion. No issues there whatsoever when it comes to their debt. They're buying back shares fairly aggressively over the last 2 years at a rate of 4.87%. You love to see that share count decrease like that. The return on capital employed has slowly been dropping, but still hovering above right at the 15% zone, 14.35% as of 2023. Again, they had a really bad quarter, and it caused the stock to tank. And I believe that it was incredibly oversold. I still think that it's at a great value. I personally got in at 160. And yeah, I still think that it's a good deal where it's sitting. And they are still growing aggressively. This year they're slated to open 1,050 new stores, remodel over 2,000 of their stores, do 120 store relocations for a total of 3,170. And all of these are up from last year. They're opening more stores. They're remodeling new stores. They are ticking. They are doing so many great things. And I think that, if you're opening over 1,000 new stores, you're doing something right. You've got your books figured out. And I am a hard bull when it comes to this company going forward. I absolutely love Dollar General. All right, next up, we've got Ultra. This is a very popular one in the community of dividend lovers. It says a adjusted free cash flow yield of 10.18%, dividend yield of 8.53%. Payout ratio here is a little bit high, but if you look at their payout ratio from free cash flow, it is about 80%. Still high, but it is definitely not 119%. So their revenue, if you take a look here, very slow growing. Very slow growing. They are what I like to refer to as a cash cow. Over the last 10 years, their free cash flow has been increasing at a rate of 7.86%, and that falls right in line with their dividend growth, 7.89%. So their free cash flow and dividend pretty much hand in hand. Their EPS is kind of all over the place over the last 10 years. It is up 4.57%, but they have a very nice return on capital employed of 30% right now, and it has pretty much been around the 30% for a while. It fluctuates here and there, but a really high return on capital employed, definitely, and they have been increasing their dividend for, I believe, over 50 years. And, you know, if that doesn't scream reliable to me, I mean, I like that. They recently made an acquisition of Enjoy. That is the new smokeless tobacco vape company that they've invested into. And if you look here, it looks like they are expecting things to pay off with this acquisition and to actually expect a return on invested capital by 2027. So still a couple years from now, but this company is just a cash flow machine. They know how to make money, and inflation's not really hurt them because they just increase their prices a little bit, and they're able to do that. They're such a good company at just making cash. Alrighty, next up, we've got Truist Financial Corporation. The reason I picked this bank stock out of all the other ones is free cash flow. I love free cash flow. I love companies that have increasing free cash flow. They have an adjusted free cash flow of 28%, bonkers. They have dividend yield of 6.63% and a payout ratio of 45%. If you look here at the revenue streams over the last 10 years, increase at a rate of 8.71%. The dividend has been, the free cash flow, if I could talk, has been increasing at a rate of 11.46% over the last 10 years. EPS over the last 10 years, 5.43%. And it looks like things have accelerated over the last 5 years at a rate of 10.84%. And that dividend over the last 10 years, 8.5%. So, good little bit of growth, good high dividend. This is one of my dart throws, what I would call it. If you think that the banking sector is going to be fine going forward and that the big hiccup here where everyone freaked out when Silicon Valley went under was overplayed, Truist Financial I like when it comes to banking stocks. If I was to own one, it would be this. They had a recent high of right at $50. Nope, they broke the $50 mark. So this company is down to $30.61. That's a nice little discount if you ask me. Their price to book is 1.03. I know this is one thing a lot of people like to look at when it comes to their banks. You don't want this to be like 1.5 or 2. So yeah, Truist Financial, you're looking for a financial stock, you're looking for a high dividend payer, might be something you want to look at. They are a top 10 company, top 10 commercial bank in the United States, and they have total assets of $574 billion. So they have a lot of depositors. And lastly, the biggest dart throw in my eyes, but I was just wanting to point this out to you, HP Computer Company. So let's take a look here. They got a adjusted free cash flow yield of 6.28%. They have a dividend yield of 3.48% and a payout ratio pretty low at 38.3%. Now, their revenue over the last 5 years has been increased at a rate of 5.48%. Their free cash flow, slow a little bit, 2%. The thing with this company is you might look at it and it might look a little ugly, They got some debt, $9 billion debt. Their EBITDA is $6.6 billion. I don't think that's an issue. The dividend's been increased at a rate of 14.8% over the last 10 years. That's nice. The big thing with this company, Warren Buffett loves this company. Let me show you why Warren Buffett loves this company. So one, they've got a really high return on capital employed. So they know what to do with the money they make. And what they do with the cash that they get is they buy back shares. And boy, do they buy back shares. Over the last 2 years, they have decreased their share count by 14%. Over the last 5 years, 9.6%. In the last 10 years, 6.8%. They are destroying their share count total. Like, if we just take a look here from 10 years ago, they were at 1.97 billion, and today they're sitting at 1. So they've bought back. They are closing in on 1 billion shares bought back. And if you go back even further to 2004, so we're gonna go back 20 years ago, they've bought back 2 billion of their own shares, and they haven't reissued anymore. So yeah, that's the thing that Warren Buffett loves with this company. And also, HP to return to positive revenue growth in 2024. That's next year. So a lot of computer companies and stuff that sell computers and computer goods have been having a rough time here lately. And HP is supposed to return back to positive revenue growth, buying back shares like there's no tomorrow, still keep a healthy free cash on hand. I like what I see. They got a low payout ratio with a good dividend yield. I don't know. Again, it's a dart throw, but it might be something that pays off in the long run. But yeah, that is the 5 companies I feel like you might be able to buy and hold forever. Again, like I said, 2 of those are little dart throws, but very well could pay off in the long run. Not financial advice. Just, educational and entertainment purposes. But yeah, hope you enjoyed. Make sure to hit that like and subscribe button for more. And until next time, see yins.